All right, welcome to The Explainer. Today we are diving deep into a really popular option strategy. It's one that people use for two very specific reasons, either to generate some income or to try and buy a stock they really like but at a discount. It's this fascinating trade-off between getting paid now versus taking on an obligation later.
So let's kick things off with a question I bet a lot of you have asked yourselves. You see a stock you'd love to own, but you look at the price and think, it's just a little too rich for my blood right now. What if, and this is the cool part, what if you could actually get paid to be patient and wait for a better price? Well, there's a strategy called the cash secured put that lets you do exactly that.
To really see how this thing works, let's just walk through it. We're going to follow a hypothetical investor who's done their homework and has a super clear goal in mind.
Okay, so here's our investor. They've been eyeing XYZ Corp. They like the company, they like its prospects, but they are not in love with its current stock price of $50 a share. They're disciplined, They're perfectly happy to wait for a better opportunity.
And this is where the strategy really starts to take shape. Our investor has two potential wins in mind. Goal A is their primary objective, buy 100 shares of XYZ, but, at a price that they're more comfortable with. But they also have a goal B. If the stock doesn't drop, they don't want their cash just sitting there doing nothing. They want to earn some income on it while they wait.
So the big question is, how do you actually pull this off? How do you set it up so that you're happy with either outcome? Well, this brings us to the tool for the job. Our investor decides to sell, or as you'll often hear it called, write, a cash-secured put option.
Okay, before we go any further, we gotta break down the lingo. So a put option, think of it as a contract. It gives the person who buys it the right, but not the obligation, that's key, to sell an asset, which in our case is 100 shares of stock, at a price they both agreed on any time before that contract expires.
Now, our investor, they're not the one buying this thing. They are on the other side of the deal. They are the option writer, the seller. And by selling this put option, they take on an obligation. If the person who bought the put decides to use their right to sell, our investor is on the hook. They have to buy the stock at that pre-agreed price.
So here's the actual trade they put on. Our investor sells one put option contract for XYZ stock with a strike price of $50. And just for accepting that obligation, that chance they might have to buy 100 shares at $50, they get paid. They immediately collect a $500 premium. That cash goes right into their account, and it's theirs to keep no matter what happens next. That $500 isn't just a random number, by the way. It's based on things like how jumpy the stock is and how much time is left. Generally, more perceived risk means a bigger payday.
Okay, but what about the risk? This is where that phrase cash secured becomes so important. This isn't some wild, speculative bet. The cash secured part means our investor has to prove they can make good on their promise. They have to set aside the full amount of cash needed to buy the stock. And the math is actually pretty straightforward. A standard options contract controls 100 shares of stock. So at a strike price of $50, our investor has to have $5,000 set aside or secured in their account. This big cash deposit is what makes the whole thing work. It proves the obligation can be met, and as we'll see, that cash can even earn some interest while it sits there.
All right, so the trade is on. The premium's in the bank, the cash is set aside. Now what? Well, our investor just waits until the option's expiration date. And at that moment, it's pretty simple. Only one of two things can happen.
Look, when it's all said and done, the whole thing boils down to one simple question. Where is XYZ's stock price compared to that $50 strike price? If the stock is trading above 50, the option is out of the money. I mean, think about it. Why would anyone use their right to force you to buy stock at $50 when they could just sell it on the open market for more? They wouldn't. But if the stock is below 50, that option is in the money, and you better believe they are going to use their right to sell it to you for that higher $50 price.
So let's talk about path A. This is the get paid scenario. The stock price finishes above $50. The option contract? It just fizzles out. It expires completely worthless. Our investor's obligation disappears. They keep that $500 in premium, free and clear. And remember that $5,000 they had parked? It wasn't just sitting there. It was earning interest. So boom, goal B is achieved. They successfully generated income. All right, now let's look at the flip side, path B. This is when you're on the hook. The stock price drops below $50. The option holder says, yep, I'm exercising my right, and our investor gets assigned. Now they have to do what they promised. They use their secured $5,000 to buy 100 shares of XYZ at $50 a pop. But, and this is the beautiful part of the strategy, remember that $500 they got up front? Because of that, their effective cost per share isn't really $50. It's actually $45. They just achieved goal A. They bought the stock they wanted, and they got it at a discount.
So when you look at these two paths, it's really easy to think of one as a win and the other as a loss, right? But that's kind of missing the whole point of this strategy. The entire thing is built around a very deliberate trade-off, where either outcome lines up with one of your original goals.
And this table just lays it all out, crystal clear. In Path A, the stock behaves, it stays up, and the investor just pockets a nice cash return. In Path B, the stock falls, and they end up buying the shares they wanted all along, but at a net cost that's lower than what they were originally looking at. See, each path leads to one of their desired outcomes.
So what's the bottom line here? What do you really need to remember? Well, the reward is obvious. You generate income. The risk, though, is very real. You are obligated to buy a stock that is, by definition, falling in price. Even though your effective cost is $45, the market price could have tanked to $40 or $35 or even lower. And that means you could be looking at a pretty big unrealized loss right out of the gate. That's why this strategy really only makes sense if you genuinely want to own that stock for the long haul, even if it keeps falling after you buy it.
And that all leads us back to the big question we started with. What is this thing really? Is it an income strategy, or is it a way to buy stock? The truth is, it's both. It's this incredibly versatile tool that lets you, the investor, define the terms on which you're willing to enter a position. And maybe the cleverest part of all, it lets you get paid for your own discipline.